In this video, we'll talk a little bit about the income statement, and specifically we'll look at how capital cost allowance appears on a company's income statement and how it affects something called taxable income. So I'd encourage you to pause the video, read the problem, and when you're ready to see the solution, restart the video. In this problem, we learn about a company that is purchasing a new bulldozer. This is a construction company. They're purchasing a bulldozer, and we're told that the purchase price is $220,000. We're also told that the bulldozer falls into an asset class which has a depreciation rate of 30%. And we're also told that the corporate tax rate for this company is 27%. Other information that we can get from the problem relate to what the company's expectations are regarding the extra revenue that will be generated because of the purchase of this bulldozer, and also their estimates for what the operating costs will be for the bulldozer. So we're told the yearly revenue, and this is the yearly revenue related just to the bulldozer. The yearly revenue is $324,000, and we're told that the yearly costs of operating the bulldozer are $96,000. So at first glance, this seems like a good purchase. Quite a lot of extra revenue generated, not a lot of cost. Let's explore what happens to this company's income statement in year 1 and year 2 of the ownership of this asset. So I'll come over here and I'll make 2 columns, year 1 and year 2. And we'll just summarize here, let's say the revenue. The revenue in year 1 and year 2 is that same $324,000. And our costs are $96,000. And this is a typical structure of an income statement for any company. Typically, companies will list their revenues, and sometimes that's sales or anything that where money is coming in directly. We list that as the revenue. Then we list the costs, and usually we list the costs that are directly related to obtaining those revenues. So in this case, for the bulldozer, these are costs directly related to the operation of the bulldozer. And then we can draw a line here, and we can say we'll say the gross revenue in year 1 is $228,000, and so it is in year 2 as well. At this point in an income statement, different companies use different terms. Sometimes this would be revenue from operations. It can have different names depending on the industry, but generally speaking, it's a result of subtracting the direct costs from the direct revenue. But we're not quite done yet in our income statement. At this point, most companies' income statements will now subtract other expenses, and those expenses can be salaries of people who are not directly involved in the operations, rent, other overhead expenses, utilities, interest expense are typically put in this location. And the thing that we want to concentrate on in this video is the capital cost allowance. So the capital cost allowance is an expense. So recall that every time we purchase an asset, we're allowed to claim a certain percentage of that purchase price as an expense in a given calendar year. So here we've got a $220,000 purchase, and the question becomes, what expense can we claim related to this purchase in year one? It's perhaps a good time to point out that it would be in a company's best interest to claim as much of this value as they can, because what you'll ultimately see is that the higher expense you claim here, the less tax we end up paying. This is why we have rules surrounding the amount of depreciation expense a company can claim, and it's to prevent companies from trying to reduce their tax artificially through the purchase of assets. And in fact, in Canada, the half-year rule is designed to prevent companies from making major purchases as they approach the year end in order to get a large depreciation expense on their income statement. So it doesn't matter when they do it in that first year, they're only allowed to claim half of the regular depreciation rate. And that brings us to year one calculations for this bulldozer. And I'll write the calculations in a bit small here. We've got a purchase price of $220,000, and we have a depreciation rate of 30%. And because this is the year in which the bulldozer was purchased, we have to put in that half-year rule. So this is the calculations behind the CCA that's an allowable expense in year one. And if you work that out, that comes out to $33,000. I'll just continue on with year one. So now we have, let's say, what we call a taxable income. Our taxable income is then our gross revenues minus our expenses. And in this case, our taxable income is $195,000. For year two, the calculation of our CCA depends on our undepreciated capital costs. So remember, we purchased this bulldozer for $220,000, and then in year one, we claimed a depreciation expense, or a CCA, capital cost allowance, of $33,000. So in year two, and again, I'll just write the calculations in small, we have $220,000 minus $33,000, which is what we claimed in year one. So this represents the undepreciated capital cost of the bulldozer at the end of year one, or the beginning undepreciated capital cost at the beginning of year two. We can simply multiply that by the depreciation rate, and we end up with $56,100. So notice that our capital cost allowance in year two is actually higher than it was in year one because of this half-year rule. Now our taxable income at the end of year two is $171,900. At this point, we introduce the income tax rate, and the company will pay tax, and they'll pay tax at we'll assume they're going to pay at their marginal tax rate, which is 27%. So the 27% comes off this amount, so 0.27 times 195,000 is 52,650, and 46,413. Now we subtract the amount of tax the company has to pay from their taxable income, and we come up with what's called the net income. or sometimes called the after-tax income. And the after-tax income is $142,350 for year one, and $125,487 for year two. So this is how we calculate the net income for a company, taking into account their CCA in a given year, keeping in mind the half-year rule. It's important to note that when we have before tax, right, so this is before tax, any before tax cash flows, we can convert those to an after-tax cash flow by multiplying by 1 minus t. What we did here was we actually took this number, multiplied by the tax rate, and then subtracted it to get this. Well, you can think of it another way. In order to go from the before-tax income to the after-tax income, we can simply multiply by 1 minus t. And we'll see this in future problems where we have engineering economics problems with before-tax cash flows, and the way that we convert those to after-tax cash flows is to simply multiply by 1 minus t. So in this problem, we really have introduced the idea of the income statement and also how we incorporate the CCA inside that income statement to come up with a taxable income, and then we see how we apply the tax.